Let's start off with cyclical. So now we're buying a company that is driven by economic cycles. Really, the strategy here is to pick key points to buy and sell. You want to buy it as a company is usually coming out of a downturn, or the industry is coming out of a downturn. And then you sell it as the industry peaks and it starts to go down again. And then you rinse and repeat, buy it as it comes out of the downturn, sell it as it starts to peak. So the strategy here is to look for signs that an industry is about to go into an upcycle again. Here we have the European area manufacturing PMI. It's an indicator for industrial activity in the European Eurozone. You can see that Euro activity started to decline for a little bit around mid 2016. And then there was starting to be signs at the end of 2016 going into 2017 that the cycle is starting to turn up again. And you can see for the next 2 years, European activity just was growing. So then you want to invest in a company that has its business driven by that cycle. So example would be Manpower. That's a staffing company that provides temporary staffing labor in Europe. We're looking for a stock that is pricing in a down cycle already or a recession. So this company, so the green line over here, you can see the stock price had come down. The valuation, so this is the price to earnings multiple, it also come down at basically a low for the cycle. And then the earnings estimates, so that's the black line over here, are also depressed. So there's really no growth is expected for the company. So then that's a perfect time to buy it right as activity has started to improve at the end of 2016 and going into 2017. So as activity improved, it drove up the earnings growth for the company. So earnings recovered. As manufacturing activity picked up, you can see the price moved up and also the valuation of the company. So the price to earnings multiple also came up. And then you want to sell it usually at the point when the valuation multiple has reached its peak for a typical cycle. And also a key sign is when the earnings are stopped growing. So that's a key time to sell, usually probably around here. And so the total return for doing this is 100%, so over a 1 year period. Dividends. So this is buying a company primarily for the income from the dividends that you get when the company pays its shareholders. So really the goal here is just to get income and cash from the company. So the strategy here is to look for a company that pays a consistent dividend. A key sign of this is a company with stable earnings growth or stable earnings. So here we have Starwood Capital Group. This is a measure of their earnings per share. You can see it's very stable, even though it's got a couple ups and downs. Now, what you're looking for at a dividend company, so this is Starwood, it's a mortgage real estate investment trust, or REIT for short. So I want to be looking at the dividend yield. So that gives you a sense of the income that you're going to get. So that's 10% off the price that you pay for the stock. And it's because earnings are stable for the company, you can see that dividends basically haven't changed for the 10 years, which is great. It's stable, it's remained consistent. And so that your total return from investing in a company like this would be 10% every year in cash. You can also compound that if you reinvested it. So the size of your position would double or 2x about every 7 years from a 10% compound rate. Fast growth. So this is buying a company with really strong earnings growth prospects. Basically, you're just looking for growth. You just want things to go up. So the strategy here is to look for a new product and growing market. Ideally, the bigger, the better. So right now, AI is a big trend. There's a lot of spending going into chips for data centers to convert them to do AI. And so you want to look for a leader that's taking market share and just making a lot of earnings from that trend. So a clear one for this would be NVIDIA. It's the advanced chip maker. Their chips are number one when it comes to market share for AI data centers. And then the strategy here is you just buy and hold this company knowing that the trend is going to drive its earnings. The black line has just gone up. That's its earnings. And then that drives up the price. So that's the green line that goes up as well. You buy and hold. So from 2020 onwards, that translates into a total return of 2,100 over 5 years, so which represents an 86% compound annual growth rate. And this is why when you have a really big market and big trend, it's really better for growth. Deep value. So this is buying a company at a really deep discount. Pretty simple. And the indicator that you can use is the price to earnings multiple. So here's the multiple for AMN Healthcare. It's a healthcare staffing company. You can see around 2020, that's when the stock was really cheap. Once you find a cheap stock, you're really looking for situations where the business can improve. And then you're buying it at a low multiple, and that's how you get the returns. So for AMN, because it's a nurse staffing company, you can see that going into 2020, that's when earnings really went down. They were depressed because of the pandemic shutdowns. When there's less activity in the hospitals, less work for nurses. You can see the valuation came down. This is the price to earnings ratio. Black line is the earnings. And so as the economy reopened in 2021, you would expect a business recovery as hospitals reopen again. And that's obviously exactly what happened. So earnings recovered for the business. It started to grow again. You can see as a result, the valuation also started to move up. Put those things together, the price moves up as well. And so then for a value strategy, you would sell it once the stock revalues to now a potentially premium valuation. Or just like any company, if the company is not growing earnings anymore, like around here, that's probably the time when maybe you should sell the stock. So total return over that time period for this strategy is 130% over 1.5 years. So arbitrage. So this is where you're buying one security and selling another one that are basically equivalent, but have a discrepancy in their price. So you buy one, sell one other. And then you make a return when the spread between the prices narrows, when the valuation gaps starts to get smaller. The strategy here is you look for basically equivalent assets. So MicroStrategy, because it just bought a ton of Bitcoin, most of the value of MicroStrategy at this point comes from its Bitcoin holdings. So they're basically equivalent assets. And you notice around in early 2021, going into mid 2021, you see that the price of MicroStrategies went up a lot more than Bitcoin from this time period onwards. So that's when the value of MicroStrategy increased a lot more than the actual value implied from the actual holdings of its Bitcoin. So then what do? You can do an arbitrage is where you buy Bitcoin and then you sell MicroStrategies because the valuation gap is too wide. You expect it to narrow. And so as a result, Bitcoin goes up, MicroStrategy goes down, and then you collect the difference in those two returns. So for that time period, using that arbitrage strategy, you would make 40% in 3 months by buying Bitcoin and selling MicroStrategies for that period. Turnaround. So this is buying a company that is in a process of a turnaround, basically going from bad to good. So the strategy is to look for a company that has brought on a new management team and new strategy. So like Restoration Hardware, Gary Friedman, a retail guy, took over in 2001, shifted the brand to be a really fancy upmarket retailer. And he took full control in 2014. The company happened to also IPO around that time. And basically, you're looking for signs that the company is, one, changing, and two, also growing its earnings. So it's very clear that Restoration's hardware strategy is working. You see this big growth in the earnings per share. That's the black line over here. And of course, that's moving up the stock price, the green line. And so then you just buy and hold as the company grows. You make the money from the share price increase as the earnings grow. And then that translated into a 600% return over those 10 years, or about a 17% compound annual growth rate each year. So compounders. So this is buying a company that can just grow at a really high rate of return. But the key thing is for a very, very long time. We're talking decades here. So the strategy here is to look for a company with both steady growth and a really large opportunity, like Costco, which is selling all sorts of goods to customers. And the key thing is to look for some kind of competitive advantage. So one of the signs of that is a rising return on capital. This is return on invested capital for Costco. It's been increasing, which means they're making a lot of profits as they reinvest their earnings and not losing to competition. So what happens if you can steadily grow like Costco has, keep expanding your footprint, and then keep reinvesting the money that you make at higher and higher rates of return? You can just compound your earnings. You get continuous earnings growth, steady year after year of year. It compounds. And then the price also basically compounds as well, just basically at the same rate. And so then you buy and hold one of these companies, basically as long as it continues. It could be 10, 20 years. And this is why big markets are key for compounders. And so for Costco so far, for the past 10 years, has returned 720%, or about a 23% compound annual growth rate. Special situations. So this is where you're looking for corporate events like restructuring or spinoffs, because sometimes that gives you really interesting new companies to invest in. So the strategy here is just to look for events where, as an example, a company like GE has spun off a company called GE Vernova, because sometimes they're really great new stocks to invest in. This is an electric power company, which happens to be great timing because right now there's so much demand for power from AI. And so this spun off in April 2024. And because the company had a ton of bookings already, usually when you have spinoffs, they usually sell it at a reasonable valuation, and they position the company pretty well to be bought by investors. So you can see we had strong earnings growth. And because the price was pretty reasonable, the way it was valued, the price also moved up as well. So as a result, this one did great. 200% return over the past 1 year or less than 1 year. So commodities. So this is buying a company that directly benefits from a change in the underlying commodity price. Basically, if the price goes up. So example of this and the strategy here is you want to look for commodity markets where there is a lot of constrained supply versus demand. So meaning an imbalance, and the price starts to move up because of that imbalance. So example is tanker rates. This is the price for shipping and transporting oil. Because there was a limited supply of ships for many years, any sort of increase in demand started to move rates upwards. So the market was quite constrained. Rates were starting to move upwards starting in 2022. So what you do is you want to buy a company that directly benefits from that price. So Scorpio provides ships for oil product transports, directly benefits from the increase in the rise in shipping rates for transporting these oil products. That directly impacts its earnings. So that's why you see in 2022, moving forward, the earnings went up. The black line is the earnings went up. And of course, the price moved up with it. And then you want to sell these type of plays when the commodity price ultimately comes down, when there's a lot more supply. We might not be there yet. So that's why the stock has been kind of staying at this level, because they're making pretty good earnings. Total return from doing this and getting that increase in commodity price was 330%. From 2022 onwards, or about a 62% compound annual growth rate. Small caps. So this is buying a smaller company with the potential to grow larger. The key thing is to look for a company that can scale. So the strategy is we're looking at smaller companies that are about under 10 billion in market cap. That's the technical definition. You're just looking for a way that this company can get bigger, a lot bigger. So like Casella, it's a waste company. They've been buying up all these waste facilities in the Northeast US, and they've been using their earnings to buy up these smaller waste companies, integrate them. It's a roll-up strategy. So then they keep growing their earnings as well. So they've been growing their earnings for a long time. And the strategy is just like some of these other ones, is buy and hold for the growing earnings. You see also that the valuation moves up as well, because as a company starts to become larger, more larger investors can buy it. And you put those things together, the price, so the green line moves up, and you get a really great return of 2,008. I can't see it, but 2,800%. So over 10 years, that's a 39% compound annual growth rate. Shorting. So this is where you sell short, meaning you borrow shares, you sell them to then buy them at a lower price. So basically, you're looking for a company that's fundamentally mispriced, and it's usually bad companies that are overpriced. So the strategy here is look for a company with a really high stock valuation, with signs that it can't really make any real profit. So it's a really bad company. It's like 2U, right? We have revenues going up, but if you look deeper, you see the free cash flow, which is like the cash the company is making, has been negative for many years, and it's not improving at all, even as the company grows. It's just a business that can't make money. So then the strategy here is you sell short, meaning you borrow shares and then you sell it, and with the intent of buying it back at a lower price over time. So valuations are really high at these points in time. Investors started to catch on to the problems, but you had another opportunity over here when the companies really deteriorated because it just couldn't make any money. So what happens is the price moves down to reality, you sell short, and then you just buy back either when it gets to a valuation level that's reasonable, where a value investor would start looking at it, or like with 2, you just sell it, or you just wait until it goes bankrupt. But it's probably better to sell it around here. So total return for this was 80%. So over those 2 years, and of course, shorting is a little tricky because it depends on where you decided to short and where you close your position and whether or not you added to it. Okay, catalyst. So this is buying a company ahead of a key event like an earnings release, and the stock will revalue as it reflects that new information. It's usually some kind of turning point in the stocks or in the business. So the strategy here is you got to understand or analyze a stock price to understand what's going to change expectations in the stock. And then you prepare for the key information, and it's usually some kind of a key number in an earnings release, for an example, that would indicate a turning point in the business. So for this company, Gartner, their earnings were depressed for quite a while because they made an acquisition sometime in 2018 or 19. And so the stock price just basically didn't go anywhere. And of course, the pandemic didn't help, lost some business over there as well. So the key report was guidance coming in the beginning of 2021. So it's coming up probably right around here. I think, yeah, right around here, where they released earnings and they gave out their guidance for 2021, and they showed signs of improvement. They showed that the company was starting to grow again. So you can see as a result of that, because of that significant change in expectations, you see this huge spike in the earnings per share estimate. So that's the black line over here. And of course, the stock also shots up vertically as well, because it's a turning point, because now investors are seeing that the company can grow again. So the strategy here is just basically to be prepared, knowing the key information, getting a sense of what number will change the expectations of everybody on the stock. You buy it ahead of the earnings release, and if the information is confirming that there's a turning point, you can also add and just keep holding as long as the earnings grow. And then you can either sell at this revaluation or just continue to hold it. Obviously, if the company is doing well, you might want to just keep holding the stock. So total return for that time period is 78% for 1 year.